welcome you to our webinar today, Supply Chains to Admire. This is a research project that we have been working on for the last 2.5 years. And, you know, supply chain leaders are competitive and they want to look at, are they driving improvement? Are they driving performance? And we wanted to understand where we're at and what kinds of technologies or processes had made the greatest difference in supply chain. So today what I'm going to do is I'm going to walk you through the evolution of the research and how we came to determine the 15 supply chains to admire. We recently announced this research at our Global Summit, and we will be doing a similar exercise in 2015. So the work isn't done, and as you listen to what we did, we'd love your feedback to see how next year. So the supply chains to admire was work that we did with Arizona State University and was based upon publicly information based upon balance sheets and income statements. In the founding of Supply Chain Insights, I built a research team that would allow us to harvest the data that we had collected on supply chain ratios from the period of 2000 to 2013. And we wanted to look at supply chain ratios because we wanted to compare small companies to large companies, and we wanted to compare companies across currency. And we also wanted to be able to look at what were gnarly patterns in financial balance sheet information, and I'll talk to you a little bit more about this. But, you know, to do this, we asked the Arizona State University Operations Research Team to help us, and Dr. George Runger has been on many webinars that we've done through the summer, and he and his research students actually helped us with some of the science and operations research techniques to be able to determine the supply chain index. Again, this work will continue through the 2015 period, and with all our research, we want to be open and sharing the research to be able to really serve the needs of the greater supply chain community and to be able to get your inputs. So why did we do this research? Well, we find in our quantitative research, and we do about 40 quantitative studies a year, that supply chains are stuck. You know, we can hear that in the voices of supply chain leaders as they talk to us on the phone and they say their supply chains are traditional, they're cautious, and they're not proactive. And so this particular slide has come from a compilation of quantitative research studies based upon the work that we've been doing. And so when we look closer at the balance sheet numbers, what we found in each of the industries was that we have improved revenue per employee, which the way that we calculate this is the number of employees reported on the balance sheet and, you know, adjusted by revenue. And you can see that across the last decade that all industries have improved revenue per employee. We've also improved cash-to-cash cycles, but the way we've improved cash-to-cash cycles is we've elongated payables, and that has improved the cash-to-cash cycle. But when we look at inventory turns, it's not as pretty of a picture. And when we look at operating margin, again, we find that we're struggling at the intersection of operating margin and inventory turns. Now, you might say, well, haven't we heard, you know, project after project and presentation after presentation and writing after writing about how if I do X, Y, and Z that I'll improve operating margin and inventory turns? Well, that's really where I was at when I sat down to write the book, Bricks Matter. I wanted to write a celebratory book of how 30 years of supply chain management had improved operating margin and inventory turns. But what I found was that we'd improved revenue per employee, but had not translated it into operating margin, and we had improved cash-to-cash, but not necessarily improved inventory turns. And in fact, most of the time we were pushing cost and waste backwards in the supply chain to the suppliers. So I wanted to know more. I wanted to really delve in and understand, why are we stuck? And so in the research, I found that demand is growing. And while many of our supply chains are hardwired to think about supply, and we focused a lot on supply chain visibility, which is about make and source, maybe deliver, But that if we look at, where the pain is today, it's rising in the area of demand volatility and operations complexity. In fact, this is a growing risk for most companies that are really struggling with supply chain excellence. And we've designed supply chains inside out so that we catch orders and we catch shipments and we work on perfect orders, but we're not really aware of the latency and the issues with that order when we receive it, because the latency in the channel has increased. And it's ironic that data is more pervasive and that social data is giving us less latency of data, but our supply chains are still working on pretty traditional signals, and they're inside out. They're not outside in. So when you look at this chart, it's 5 years ago versus what supply chain leaders project for the next 5 years. And the growing issues around demand volatility is very clear in the work we've done on the supply chain index and the work around global operations compliance and the need for regional global governance. We also hear that, the long tail of the supply chain and growing complexity, that as product portfolios have increased, as product life cycles have shortened, as we try to do more in the channel because growth has flattened in modern trade, that more and more companies are struggling with complexity. And, complexities like cholesterol, we have good complexity, which drives top-line growth. We have bad complexity, which drags costs and doesn't translate to growth. But only 8% of companies can easily get a cost to really determine good complexity from bad complexity, but the long tail of the supply chain is whipping the supply chain around more and more. Also, we've talked about the bullwhip effect and the demand latency and distortion of the signals across the network, but what we've really done is we've automated the enterprise. We've just made small steps into business networks. So that was a little bit of our understanding and our research as we heard companies talk about being stuck and the issues around the more traditional approaches and how could they get unstuck. And we found that in balance sheet information that 9 out of 10 companies were actually stuck at the intersection of operating margin and inventory turns. So the research that I'm going to share with you today, what we did was we took all publicly held companies, so of course we couldn't get to private companies, and we grouped them by peer group, and we looked at how many companies were able to make progress for 2 years, 3 years at the intersection of operating margin and inventory turns, and the results surprised us. 9 out of 10 companies are stuck. So the question was, well, why are they stuck? Well, we talked about business issues previously. But one of the issues is that many organizations mistakenly focus on functional excellence. And in functional excellence, what we'll often do is we'll make a function really strong, but the functions can't orchestrate across each other. So for example, maybe in procurement I get the lowest cost, but maybe that lowest cost doesn't translate into the best cost because maybe the goods purchased cannot be purchased at the rate in which manufacturing needs it, or perhaps the cycles of procurement don't match with the rhythms and cycles of the supply chain. So let's take logistics. I've got to balance logistics costs, which are becoming more constrained with what's happening in manufacturing, but most companies can't do that because they're very stuck in silos. Or I reward manufacturing by return on assets, which causes them to run more inventory. And also on customer service, many times people are stuck really looking at, what are the policies and how do I translate demand? So the organizations that tend to be more functional in nature tend to be more stuck. The second thing is a project-based focus is not helping us. So when we looked at the balance sheet information, that we found that, after a big project, that often a company could make progress for 2 years, but then it couldn't be sustained. And across all of the industries that we would see fall off in 3 years, and after 4 years, even more fall off. So we were wondering what would happen if we took this data and we looked at the impact of the recession. And what we found is with each recessionary period, that supply chains pull up and they'll improve operating margin and inventory turns, but they can't sustain it. And that, as we get into the recession, about a year after the recession, simplify the business. We'll really focus on the basics. But then the trend is to really drift back and to become more functionally oriented. So this really got us thinking. You know, we've been at supply chain a long time. You know, the promise of supply chain was that at the intersection of operating margin and inventory turns, or growth and return on invested capital, that we would drive progressive results. I expected, because I've been an analyst, first with Gartner and then at AMR and then at Altimeter, that we would see over this period, the last decade of investing 1.7% of revenue in IT and supply chain processes, that we would be pushing towards this best scenario. But that's not what we found. So when we actually got to looking at it, we found that the supply chain is a very complex system, and that the relationships of these metrics are nonlinear, and they're very tightly coupled, and that it's a complex system with complex processes with increasing complexity, and that most companies do not understand the issues around managing the complex system, that they'll often focus on a singular metric throwing the supply chain out of balance, or the lack of strategy, or they'll become very reactive, throwing the supply chain out of balance, not allowing the supply chain to actualize its potential. So we built the model that we call the supply chain effective frontier. And what we wanted to do was we wanted to take balance sheet and income statement data, and we wanted to group it into supply chain ratios to look at the trade-off between growth, profitability, cycles, and complexity. And the work that we've done on the supply chains to admire is based upon this model to say that supply chains that we admire raise the level or increase the potential of the supply chain in these four categories. They're able to trade off the issues of complexity with the cycles, and they're able to get to cost and to make the right decisions against profitability and inventory, and they're able to power growth. I firmly believe that the supply chain is an engine of growth. So what we did was we started plotting the intersection of metrics in orbit charts, and we did about 2.5 years of this work. We would say to companies, let's do some financial benchmarking on the database of 15 years of supply chain financial ratios, and we'll plot the data and you tell us the story. And what we found was that there's no company that has a linear progression against this best scenario. And in fact, this is Walmart, and in the charts that I'll show you, which a lot of them are very gnarly patterns, each of the companies will have their stock ticker in the box, and they'll have the averages in the box for the period. This is a period from 2000 to 2013, and it shows the progression of a company over this period of time, really managing through this complex system. So in this particular pattern, you can see that Walmart has made great improvement in inventory turns, but not so much in operating margin. Let's take Apple. Apple has made great improvements in operating margin, but not so much in inventory turns. We often will find that this is the case, that companies will move one metric forward, but not the other, and that they're not able to go towards the best scenario. So again, a fundamental principle of the supply chains to admire is that they're increasing the potential to manage the metrics of the balance sheet across the portfolio in a balanced way. We also found that some companies like Dow Chemical and Flextronics, and I can go on, have actually not made any progress in either metric. They're at the same level in 2013 that they were at 2000. And again, the patterns are more gnarly and they've got more erratic behavior than those that you saw with Walmart or Apple. And, you know, this is the characteristic of a supply chain that is lower performing. Walmart and Apple are higher performing supply chains than Dow. And so as we looked at these patterns, and this is Procter & Gamble, many people think about Procter & Gamble as a supply chain leader, okay? Again, we're going backwards in operating margin. But let's take a look at someone like Mattel, right? Again, this is a very, very gnarly pattern. And so as we looked at all the patterns, we came to the belief that the best supply chains were balanced across these metrics, that they were strong, driving towards these best scenarios, and they were resilient with a very tight pattern, but they wouldn't have the swings that we see with Mattel and Dow, but they would have a strategy that could be executed through supply chain systems. And what we found was that the best companies, the correlation on market capitalization, actually had very tight controlled patterns. So that began the work where we started to look first at value chains, and we tried to say which companies were making the most progress. And so this is the consumer value chain, and you can see Walmart is the little black pattern. You can see BASF, which is a major chemical manufacturer that's contributing to the consumer value chain, is the purple pattern. VF, which is a major apparel, is at the green line. Hershey, which is a food and beverage company that's actually made a lot of improvement, is the blue area, and Colgate is operating on the red line. So you can see that all of these companies in the value network are operating in their own plane. And while we've talked about value networks for a long time, we really haven't made a lot of progress in value networks. What we have done is some companies have made progress within their peer group, but we've really not made a lot of progress in value networks. So we got back to work, and what we wanted to understand was if we took just company data and we tried to correlate the company data to market capitalization, what did we find? And to do this, we did linear regression, 6 years of market cap data with quarterly points, which would look at the number of shares outstanding times the market price of the shares. And then we took the companies across the industries and we did the calculations of regression to be able to look at which of the financial ratios correlated the highest with market cap. Our belief was that supply chain leaders wanted to drive improvement in market capitalization, and we wanted to help supply chain leaders to better talk the language of finance. Now, in this work, what we found was return on assets, which is often used as a measurement of manufacturing excellence, is actually not very highly correlated to market capitalization. But something like inventory management, which we're really not very good at, has a very high correlation. And so what we decided in terms of metrics to work on for looking at supply chain excellence is we decided that across the model of the effective frontier, we would pick a metric in each of the categories that was tightly correlated to market capitalization. And we looked at all of the metrics across many industries, and all of these reports and the orbit charts are on SlideShare if you want to look at your individual metric in industry, but we worked on this for a couple of years. And then we actually contacted Arizona State University and we said, based upon these gnarly patterns in these orbit charts, how can we determine which companies are making the most progress? What we believe is that we've got a balance factor, which is at the intersection of return on invested capital and revenue growth, and you could see on the market capitalization that return on invested capital had a higher correlation with market caps than return on assets or return on net assets, and that was why we picked it. And we believe that supply chain leaders need to maximize asset values. The second thing was strength, which we believed was the intersection on the orbit chart of inventory turns and operating margin. What we wanted was a way to calculate the progress of how are companies actually making progress at that intersection. And then we also wanted to look at the tightness of the pattern at inventory turns and operating margin. So we believe that the best companies, based upon the 2 years of research of looking at the industries and doing the market capitalization data, would be balanced across the portfolio. They would be strong, driving year-over-year improvement, and they would have a tight pattern looking at inventory turns and operating margin. And so we built the supply chain index. And before I go forward, I want to just say that the supply chain index is a measurement of improvement. And a company that is not as good on supply chain as another company will drive improvement at a faster rate. It's sort of like weight loss, right? If on the show The Biggest Loser, the fattest guy will lose the weight the fastest. And that's what we find in the supply chain index. So one of the things we wanted to do first was to measure improvement, and then we wanted to combine improvement with performance to determine the supply chains to admire. So we picked 4 metrics, 1 metric from each of the areas of the effective frontier. We picked year-over-year revenue growth, operating margin, inventory turns, and return on invested capital. And we vetted this with a small group of supply chain leaders about were these the right metrics for us to pick to be able to do our work. Next year we may change this. We're still doing some research, but it helped us to be able to look at the complex system and the work across the complex system. So we went to Arizona State University and we said, how do we best determine in math a balance factor, a strength factor, and a resiliency factor? And so what we did was for balance at the intersection of growth and return on invested capital, we looked at the proportional difference of the points on the orbit chart, and we published this methodology broadly, and I encourage you to read the methodology and give us feedback. On strength, again, we're looking at the proportional difference of change or the vector analysis at the intersection of inventory turns and operating margin. And in resiliency, we're looking at the mean distance between those points. And so we're looking at the tightness of the pattern. And so for all publicly held companies, we calculated a balance of strength and a resiliency factor. Then we grouped companies by NAICS codes, which is a way of looking at peer groups. And we wanted to find peer groups that had at least 6 comparable peers. We threw out major conglomerates like GE because, you know, it's just not easy to compare a conglomerate. And then we calculated the balance factor, the strength factor, the resiliency factor. We populated the charts by industry. And then we stack ranked them, sort of like running a triathlon. So the company that did the best in balance would get a 1, and the second best would get a 2, et cetera, to give us an overall ranking, with balance, strength, and resiliency having equal weight, which led us to be able to look at the balance factors, the strength factors, and the resiliency factors for each of the industries, because we found it very interesting to look at what are the changes at this corporate performance level for 2006 to 2013 versus a more narrow window of 2009 to 2013. What we found was coming out of the recession, you know, we saw some rebounding and redefinition of supply chain processes, but in the recent period, demand volatility has greatly increased and that growth has slowed, and that the balance factor for most industries has been a very negative number. Only few companies have been able to make improvement there. In strength, we found that the supply chains overall are getting stronger and they're getting more resilient, but this gave us a backdrop to be able to judge the companies. And then we went and we actually did each industry, and these particular charts are available on SlideShare. This is an example of the chemical industry for the period of time of 2006 to 2013, and we stack ranked the companies, and then we also looked at 2009 to 2013 to say which companies were actually making progress in those time periods, which led us to build the supply chains to admire. To build the supply chains to admire, we looked at the average performance of the company for the metrics of operating margin, inventory turns, and return on invested capital, knowing that the strongest performers would have a higher average, but they probably would not be able to drive the highest level of improvement. But the improvement ranking was based upon a company that was able to at least score an improvement ranking midway in their peer group. Now, when we actually did the performance analysis, we only ended up with 19 companies. Of all publicly held companies in these peer groups, only 19 companies were able to beat the industry average for operating margin, inventory turns, and return on invested capital across those balanced portfolios. Then when we applied the improvement metric, saying that were you making more improvement than your peer group, we were able to narrow down the list to the top 15 to admire. So let's look at those. And again, the methodology, just to go back and recap, we group companies by peer group. We strongly believe you can't put all companies in a spreadsheet and shake them up. We had to have at least 6 companies in a peer group. We started with all database of all publicly held companies. We worked on supply chain ratios to be able to compare little companies versus big companies. We excluded conglomerates. We excluded recent mergers and acquisitions. And then we calculated peer group averages for growth, operating margin, inventory turns, and return on invested capital. Did the first screen about were companies doing better than their peer group. And then the second test was, are they driving improvement? That left us with 15 companies to admire. And if we look at these companies, and again, publicly held companies, the first thing I want you to notice is that no company made the list from healthcare, pharmaceutical, medical device, absent from this chart. No company made this chart from retail, absent from this chart. In fact, what we saw in retail was that companies often would improve one of the 2 metrics, but not both together of operating margin and inventory turns. And also, if you go back to all the factors that we calculated, the toughest industries were in the industrial industries. You know, the high-tech and electronics industries had the highest volatility on the balance factors, but they made the most progress. And that really made us stop and step back and think about this much harder. So what we did was we started interviewing companies about their performance to get an understanding of why this was. And what we found was that, you know, we have some barriers like functional excellence or a focus on projects, but that we have a lot of opportunities if we can unthink traditional processes and rethink what supply chain processes can be. So let's look at some of the industries. Here's retail. And again, all these slides are going to be posted on SlideShare, and don't worry that you can't get to all the numbers right now. But again, you can see that retail will drive singular metrics, not joint metrics. Consumer packaged goods is actually a very hard one for us because Colgate's on the borderline of making the top 15. In fact, you know, we struggled with any of the consumer packaged goods companies making it at all. Colgate actually made a lot of improvement in the longer horizon for 2006 to 2013 with 42 consecutive quarters of improvement in operating margin. It's actually 10 days unfavorable to Procter & Gamble right now in inventory turns. This particular industry right now is in a major transformation, and the technologies and the processes that they've been using are no longer a good fit because they're inside out, they're not outside in. And as growth has slowed and the long tail of the supply chain has increased, complexity has risen without good systems to really get at cost. One of the reasons why I think Colgate has been able to drive higher return on invested capital and much better operating margin is a great ability to get to cost information and great HR systems. I don't find that in some of the peer group. Unilever has good improvement and could make the list in future years, but has actually come from a less desirable position. Now let's look at food. General Mills gets the nod here. While Hershey has made the most improvement, Hershey still has a way to go on inventory turns. And Hershey has done an incredible job of transformation and processes, and may make the list in future years. But General Mills has been the industry leader in being able to balance the portfolio. And even though their improvement rankings are in the middle of the pack of the industry, they are driving a tight pattern of continuous improvement and being able to really drive that across their balanced portfolio. Campbell's Soup is an interesting one. Campbell's was actually driving right at Hershey's level up until 2012, and then they did a big bang project to where they tried to implement a project too fast with too few resources, and it drove their rankings in 2013 almost to the bottom of the pack. So the supply chain index is a very sensitive metric. You know, the Campbell's Soup example is an example where a company who does a big bang project can actually go backwards. Beverage, if we look here, Anheuser-Busch comes to the top. And, interesting thing is we have competition for the share of fruit. There's a lot of, work around the redefinitions of processes. PepsiCo could have made the list if they were making more improvement. They were one of the 19. They actually fell out because of their low improvement rankings. Apparel, no apparel company other than Nike and Ralph Lauren made the list. Apparel by and large has been supply chain laggard. You can see some of their rankings. They've really been working on redefinitions of supply chains with a lot of outsourcing through labor arbitrage strategies. Chemical companies were very interesting. BASF was on the borderline to make the list. I like the work that they have done. They're a $122 billion company. They've done some really interesting work on transformation, outperforming Dow. Eastman Chemical was actually a surprise for me. I'd actually worked with Eastman for many years, and I was very proud of their numbers. DuPont, however, I think is an example of a company that has had a lot of stops and starts and hasn't really been able to make the transformation. Pharmaceutical. No company makes the list from pharmaceutical. This is an industry that has the highest operating margin and probably one of the lowest levels of supply chain results. And so you can see that we really lack the ability in this particular industry to be able to drive a balanced portfolio of results. Biogen is making the most improvements, and Novo Nordisk is actually second on the improvement. But again, you can see on the averages, they're not able to power those against the peer groups. Medical device companies are in the middle of mergers and acquisition strategies, and again, we don't see the ability to have a balanced portfolio of metrics, nor do we see a lot of change or improvement. This particular industry is the most resilient and has the lowest rate of change, so the strength factors are pretty low, but the resiliency factors are pretty good. Paper and packaging. Sunoco products almost makes the list, but they lack the inventory numbers. But, the packaging group has not been a strong performer in supply chain excellence. Semiconductor. This was very interesting to me because Taiwan Semiconductor has always been a great case study for me around value networks. And so I was excited to see them pull up to the top of the pack because I really love the case study work that they've done around building value networks, sharing design information, and powering innovation in the semiconductor industry. I also love the work that Intel has done around design and HR and human systems for supply chain, and so they pull up to the top of the pack. Automotive, TRW, pulls up, and so does Audi. This is a very troubled industry, very hit by the recession. I was glad to see automotive to have some participants. And consumer electronics, probably the strongest group of companies to be able to manage demand volatility, some of the strongest planning, some of the strongest design systems. Cisco Systems, Apple, EMC makes the list, and surprisingly to me, Samsung, who had always thought of as a supply chain leader, did not, nor did LG Electronics. Automotive suppliers, again, TRW makes the list. But, again, a lot of work coming out of that particular industry after the recession. So, again, here are the supply chains we admire. This will change next year as we refine the methodology with input from folks like you, as we do more research, as we talk to supply chain leaders about this. However, what we strongly believe after doing this research is that you can't put companies in a spreadsheet and shake them up. I just can't compare a chemical company like BASF to a consumer packaged goods company. Instead, what I need to do is I need to look within the peer group. And I've got to look at both performance and improvement because both matter. So what do we think makes a difference? As we've done the interviews with companies, leadership makes a big difference. Source, make, and deliver under a leader who has been at that company for many years. Mike Corbo, and I've done many interviews with Mike Corbo at Colgate, manages Source, Make, Deliver, And there has not been a lot of change in leadership at Colgate. It's very, very stable. You know, Keith Harrison at Procter & Gamble, very stable. The building talent, we've done a lot of research on talent systems. The constant theme within the supply chains to admire is strong HR talent systems to be able to look at career progression, to be able to look at development of employees, and really focused on mid-management talent, just not young kids coming out of school or high potential. Focus on channel data and the inclusion of channel data into processes, and to be able to look outside in to manage the channel is a characteristic of supply chain leaders. One of the early adopters of this technology and approach was Cisco Systems out of the early recession, and it helped them to redefine supply chain processes. Horizontal process focus, which is the process around revenue management, really looking at what's happening in demand shaping, sales and operations planning, supplier development, corporate social responsibility. The more horizontal we can be across the functions, the more we can balance the portfolio. Active and intentional design. General Mills does a great job of design, a great job of taking design into tactical planning. And last, supply chain planning. Those that are making the list are doing a better job on planning. So as we interview companies on the list and as we do the discussions on the orbit charts, what do we find doesn't work? A project-based focus where each project has a return on investment, and we believe that project A plus project B plus project C will equal greatness, does not work. I work with companies that have thousands of projects, and unless those projects are orchestrated under a strategy, many times a project will improve a piece of the business, but because it's not coordinated with another piece, we're not able to achieve the levels that we need to. Secondly, and I talked about this earlier, a vertical focus around end-to-end versus end-to-end. We find that only 1% of companies have an end-to-end focus. Unchecked complexity, the ability to manage good and bad complexity, big bang projects, and pushing cost and waste backwards in the supply chain. So these are some of the things that we find work and some of the things that we find does not work. Now I've got some questions here. One question is, what vertical does the oil and gas company fall into in our analysis? We actually did oil separate, so we looked at the oil manufacturers of Exxon and Shell. I didn't show those due to time, but if you want to follow up with me, we can share that data with you. We did not put those in the chemical industry, but we can share with you that data later. I have another question around what we can do about sharing this data inside an organization. And one of our principles at Supply Chain Insights is, we make all of this data available. We want to raise the level of dialogue of supply chain leaders. I have a question from Kenneth. Kenneth wants to know, what do I mean by outside in versus inside out? So Kenneth, our traditional supply chains are based upon orders and shipment data as the primary signals to align the supply chain. In an outside-in supply chain, we're very focused on channel data. We have either the data of the distributors or the data of the channel, and we are managing those processes either at an execution level or a planning level so that we're dealing with channel data, which cuts down the latency and the translation of that data and helps the supply chain to be more responsive. Particularly in high-tech and electronics, that has been a key secret to being able to overcome short product life cycles and to be able to manage the demand volatility. I've got a couple of people that want to see oil and gas, and those are available on SlideShare, and I will be sure to share that with you. Kenneth's come back and said, does that mean it's more of pull versus push? No, Kenneth, it's really the design of push-pull decoupling points. So where I want to pull, where I can pull based upon that channel data, then I pull. But typically, because I want to manage the form and function of inventory, I'll have a decoupling point. So I'll decouple the processes. Let me give you an example. I was presenting with CSCMP with Sunoco products, And one of the things that they did to improve their rankings was they set up a push-pull decoupling point for their products after their mills. So they run paper mills and rolls, and that's very much about mill products and industrial manufacturing, and they want to keep their paper mills really fully utilized. So they'll push on their mills, but then they'll decouple in postponement strategies for the raw materials as a semi-finished good, and then they'll pull when they print the goods based upon the channel data. So that's an example of push-pull decoupling strategies. What do I think is the trend in the auto and the industrial sector? Do I think the general trend is upward or downward? Well, I think that it's pretty flat, actually. I think that one of the things that we've done in automotive is we have focused a lot on procurement and work with suppliers, and not as much on good supply chain planning and not as much on outside-in signals. I get a lot of questions from automotive around how can I use channel data, and really I'm astounded that they're not using more of their internet data around how people configure cars or their distributor data. The transformation of automotive, I think, is still a great opportunity. So those are some of the questions that we've gotten. We will be continuing this research, and we welcome more questions. We do have some of the information available on our blogs, and we would love to entertain any questions that you have. We believe supply chain matters. We're on a countdown for next year's Global Summit where we ask people to imagine the supply chain of the future, and we share with them what's happening around technologies and outside processes. Our next Global Summit will be September 8th through the 10th, 2015 at the Phoenician in Scottsdale, Arizona, and we've just published all of our event content for this year's Global Summit, where we launched the Supply Chains to Admire on our Global Summit site. So you're welcome to listen to all of the videos and watch all the PowerPoints of supply chain leaders. We also offer public training, and we'll be doing our next training session in Dallas at the 1st of November. We have a podcast series. We have 106 podcast archives on iTunes and Stitcher where supply chain leaders are talking about driving supply chain performance. Please dial into those. Maybe you're doing a run, maybe you're in your car, but it's a way that you can actually hear the stories of supply chain leaders. And then we're doing complimentary webinars every month, and we archive those, and we encourage you to share those with the team. If you want more information, you can contact me. I'm Laura.Ciceri at Supply Chain Insights, and I write for Forbes. I also write a blog, Supply Chain Shaman, and we write openly with all of our reports. And we thank you for joining us today. Thank you very much. Laura Ciceri for Supply Chain Insights, the Supply Chains to Admire.